Okay, you're thinking about owning a clothing brand. The attractive version is easy to see. Choose a name, develop a few pieces, build a clean website, and sell a hoodie for several times what the factory charged to make it. The price tag can suggest a huge profit. The bank account often tells a different story. A clothing brand may show a healthy gross margin while producing little operating profit, weak cash flow, or even a loss after freight duties, fulfillment, returns, marketing, payroll, and inventory mistakes. This breakdown will show what ownership actually requires, how the money moves from the customer to the owner, and why the audience may be more valuable than the garments. Start with the number that creates the illusion. Suppose a hoodie sells for $72 and the factory invoice says $15. Subtract 15 from 72 and the remaining $57 looks like profit. It is not. The $15 figure may cover only manufacturing. It may exclude product development, samples, inspections, international freight, customs duties, insurance, packaging, warehousing, outbound shipping, payment processing, returns, discounts, advertising, software, and the people required to run the operation. The correct first question is not, what is the markup? It is, what cash must leave the business before this order is truly complete? That difference matters because revenue, gross profit, operating profit, net profit, and cash flow are separate measurements. Revenue is the full amount collected from customers before expenses. Gross profit is what remains after direct product costs. Operating profit comes later. After ordinary overhead, net profit comes after applicable interest, taxes, and other expenses. Cash flow tracks when money actually arrives and leaves. A brand can report an accounting profit while struggling to pay a factory deposit because its cash is trapped in inventory. It can also hold cash from a new collection while still owing suppliers, refunds, taxes, and advertising bills. The money visible in the account is not automatically owner income. On this channel, we examine businesses from the owner's side rather than the customer's side. That means following the dollars through startup capital, daily operations, break-even growth, and risk. Clothing is a perfect example because the product is familiar, the storefront can be launched quickly, and the hidden economics are unusually easy to underestimate. Ownership usually begins long before the first item appears online. A founder may pay for design work, technical packs, patterns, fabric sourcing, samples, fit revisions, size grading, labels, photography, website development, trademarks, business registration, insurance, and initial marketing. Some founders use print-on-demand or small domestic production to reduce the opening inventory commitment. Others place larger factory orders to obtain a lower unit cost. Neither model is automatically better. Small batches reduce inventory exposure, but usually raise the cost per garment. Large batches improve production economics only when the inventory sells at the expected price. Factories commonly require deposits and minimum production quantities because setting up machines, cutting fabric, dyeing materials, and managing a production run creates costs before one finished unit exists. The exact minimum depends on the factory, fabric, construction, color, and relationship. A minimum that sounds manageable can multiply when the brand offers several colors and a complete size range. 300 total units is one decision. 300 units for each color or style is a much larger commitment. Even when the factory allows the quantity to be spread across sizes, the owner still has to predict how many small, medium, large, and extra-large units customers will buy. That forecast turns inventory into a financial wager. Order too little and popular sizes disappear while advertising is working. Order too much and cash becomes a wall of boxes. Unsold clothing does not merely wait, it occupies warehouse space, ages as tastes change, and may require discounts that destroy the margin used to justify the order. A product can be profitable on every unit sold and still damage the company if too many units remain unsold. This is why opening inventory and working capital must be planned separately. Inventory buys the goods, working capital pays the bills, while those goods slowly become customer cash. Importing creates another layer. The factory price is not the same as landed cost. Landed cost generally includes the merchandise, freight, insurance, or related shipping charges, customs brokerage, duties, inspections when applicable, and transportation to the warehouse. In the United States, Apparel duties depend on the product's classification. Fiber content, construction, and country of origin. A cotton sweatshirt, a synthetic jacket, and a knitted shirt can fall under different tariff treatment. Using one duty percentage for every garment is unreliable. A serious importing plan needs the correct harmonized tariff schedule classification and professional guidance when the classification is uncertain. Once inventory reaches a warehouse, every order triggers another chain of expenses. A fulfillment provider may charge for receiving cartons, storing units, picking the correct size, packing the order, adding inserts, and handling special packaging. The brand may pay all outbound shipping, charge the customer, or subsidize part of it. Each policy changes conversion and margin. Free shipping can improve the offer, but the carrier still sends someone a bill. Premium boxers and tissue paper can strengthen the customer experience, but packaging becomes a direct cost repeated on every order. Payment is not free either. As of July 2026, Stripe's standard United States pricing for an online domestic card transaction is 2.9% plus 30 cents, although negotiated and alternative rates can differ. On a $72 order, that standard formula is about $2.39. A refund may not restore the original processing cost under the processor's applicable pricing. Chargebacks can add another fee and remove the sale. None of these items is enormous alone. Together, repeated across thousands of transactions, they can determine whether a collection contributes cash or consumes it. Returns are especially important in online apparel because customers cannot physically test the fit, fabric, color, and feel before buying. The National Retail Federation estimated that 19.3% of online sales across retail would be returned in 2025. That is a retail-wide figure, not a guaranteed clothing brand rate. And an individual apparel label can perform better or worse depending on sizing, product category, customer behavior, and return policy. The owner must model more than the refund. There may be outbound shipping, return postage, inspection, cleaning, repackaging, damaged merchandise, customer support time, and inventory that returns too late to sell at full price. Now build a simplified order model. This is not an industry average. It is an educational set of assumptions for one direct-to-consumer United States brand. The hoodie sells for $72, manufacturing inbound freight and duty total $23. Packaging and fulfillment total $6. The brand subsidizes $7 of outbound shipping. Payment processing is approximately $2.39. The owner reserves $6 for expected returns, defects, and related handling. Before paid marketing and fixed overhead, roughly $27.61 remains. That is contribution margin, not net profit. If attracting the customer costs $32, the first order loses about $4.39 before salaries, software, insurance, rent, professional fees, or interest. The sale looks impressive on a revenue dashboard, yet it has not paid for the organization behind it. This is the central contradiction of modern direct-to-consumer apparel. The garment can carry a strong product margin while the customer relationship begins at a loss. Customer acquisition cost is the total sales and marketing cost required to gain a new customer over a defined period. It should not be calculated by looking only at the best advertisement if the brand spends $20,000 on advertising. Creative production, agency support, and influencer fees then gains 500 genuinely new customers. The blended acquisition cost is $40. Existing customers who purchase again should not be counted as new acquisitions. Neither should unpaid orders, fraudulent transactions, or sales that are later fully refunded. A flattering calculation can hide an unprofitable channel. Advertising platforms are not guaranteed vending machines. Their auctions change as competitors bid. Audiences become saturated. Creative performance weakens, and privacy rules alter measurement. Apple's App Tracking Transparency Framework, required with iOS 14.5 in April 2021, made permission necessary before apps could track users across other companies' apps or websites, or access the advertising identifier. That did not end digital advertising, but it changed the information available without consent and made measurement and targeting more complicated for many advertisers. A clothing brand, therefore, needs multiple ways to create demand rather than assuming yesterday's advertisement will keep producing tomorrow's customer. At the same cost, influencer marketing carries a similar risk. The visible size of an audience does not reveal how many followers are in the brand's target market. Trust the recommendation. A fixed creator fee becomes profitable only when the attributable contribution from orders exceeds the fee and related product, shipping, and management costs. Views, likes, and comments may help awareness, but they are not revenue. Revenue itself is not profit. Owners need tracking that distinguishes reach. Website visits, first-time buyers, repeat buyers, refunds, and contribution after variable costs. This is why successful clothing businesses often treat the first purchase as the beginning of the economics, not the end. Customer lifetime value estimates the value of the customer relationship across future purchases. The useful version is based on contribution after direct and variable costs, not simply total revenue. A customer who spends $300 over 2 years is not worth $300 to the brand. Product cost, fulfillment, shipping, returns, discounts, payment fees, and service still have to be deducted. Lifetime value also needs a time period. Cash expected 3 years from now cannot pay a factory invoice due next week. Email and text messaging can reduce dependence on repeatedly buying the same person's attention from an advertising platform. But an email list is valuable only when people joined lawfully. Remain engaged, trust the brand, and continue buying. Sending more messages does not automatically create loyalty. The product must fit, arrive when promised, match the photographs, survive normal use, and justify its price. Customer service must resolve mistakes without turning every complaint into a public argument. A brand earns repeat purchases operationally before it monetizes them through marketing. Branding is not decoration placed on top of the business. It is part of the customer acquisition system. Most garments compete with many alternatives that perform a similar physical function. The brand must give a specific group of people a reason to notice, trust, choose, and remember its version. That reason may come from design, fit, durability, cultural relevance, community, service, values supported by evidence, or a combination of these. Photography, video, copywriting, packaging, events, collaborations, and social content translate those differences into attention. The owner may believe the company makes clothing, but a large portion of daily work involves publishing media and managing perception. The danger is spending heavily on appearance before proving demand. A beautiful campaign can make weak inventory look important for a week. It cannot force customers to reorder. Owners should separate brand-building expenditure from product economics and test whether each collection produces measurable behavior. Did qualified visitors reach the website? Did they buy at full price? Which sizes were returned? Did first-time buyers come back? Did a product create referrals? The point is not to remove creativity. It is to give creativity a financial feedback loop. Clothing also has a difficult protection problem. In United States copyright law, clothing is generally treated as a useful article. Copyright may protect separable pictorial, graphic, or sculptural features, such as original artwork applied to a garment, when legal requirements are met. It does not automatically protect the functional shape of every garment. Trademarks, design patents, contracts, and other protections may apply in particular circumstances, but they have different standards and costs. Owners should not assume that placing a design online prevents competitors from producing something similar. The practical defense is broader than a legal filing. Speed, quality control, customer trust, recognizable communication, reliable delivery, and an owned audience are harder to copy than a silhouette. A competitor may reproduce the visible idea while lacking the original brand's relationship with customers. Still, copying can shorten the profitable life of a product. That makes inventory discipline even more important. The better a collection performs, the more tempting it is to reorder aggressively. The owner must decide whether demand is durable or merely a brief trend. Compliance creates less exciting work that cannot be ignored. In the United States, most textile and wool products need labels identifying fiber content, country of origin, and the responsible manufacturer or marketer. Clothing manufacturers and importers also have care label obligations for covered products. Product claims must be accurate. Sales tax, registration, and collection duties depend on where the business has obligations, and employment, privacy, advertising, and consumer protection rules can also apply. The website may feel global, but the legal responsibilities are attached to real transactions, real workers, and real customers. Now look at the business through a full month instead of one order. Maya operates a simplified online brand with no physical store. Her model sells 1,000 hoodies at $72 each, producing $72,000 of revenue. Using the earlier assumptions, the orders generate about $27,610 before marketing and fixed overhead. 450 orders come from new customers acquired at $32 each. So acquisition spending is $14,400. She allocates another $1,000 to retention software and campaigns. That leaves about $12,210 before fixed operating expenses. Suppose fixed monthly expenses in this educational model are $9,000 for payroll, contractor support, software, insurance, workspace, accounting, and general administration. Operating profit is then about $3,210 before interest, taxes, owner distributions, and unusual costs. Revenue is $72,000, but the amount available after the modeled operating expenses is less than 5% of revenue. Maya cannot call the entire $3,210 personal income. She may need to retain it for the next inventory deposit, a slow month, a tax payment, a return spike, or replacement inventory. Change only one variable. If 700 of the 1,000 orders require paid acquisition at $32, acquisition spending becomes $22,400, with the same $1,000 retention budget and the same fixed costs. The month moves from a modest operating profit to a loss of roughly $4,790. The product price, website, and order count are unchanged. The customer mix changes the result. This is why a growing brand can report record sales while its cash position worsens. Break-even, therefore, depends on contribution per order and fixed costs. If the brand retains $20 after variable costs and marketing on the average order, and fixed monthly costs are $40,000, it needs about 2,000 orders to cover those fixed costs. If contribution falls to $10 because returns or acquisition costs rise, the required order volume doubles. More sales help only when the average sale contributes enough to overhead. Scaling a negative contribution does not repair the model. It accelerates the loss. Growth adds working capital pressure even when contribution is positive. A factory may require a deposit months before customers pay. The remaining balance may be due before shipment. The warehouse may need inventory before a major launch. Advertising is often paid quickly. While payment processors can hold reserves or delay funds in certain circumstances, refunds arrive after the original sale. A fast-growing brand can become cash poor because it is continuously funding the next, larger production cycle. Profitability and liquidity must be monitored together. The owner-operated and manager-operated versions also differ. A founder who handles product development, content, customer service, and operations may avoid several salaries, but that does not make the labor free. It means the owner is contributing unpaid or underpaid work. A manager-operated brand needs enough gross profit to support capable leadership and specialists. When owners compare their results with another label, they should ask whether the other founder's labor is included, whether warehouse work is outsourced, whether advertising creative is produced internally, and whether owner compensation appears above or below the reported profit line. Supply chain concentration is another ownership risk. Depending on one factory, one fabric mill, one country, one freight route, or one fulfillment center can make the brand efficient until that single point fails. Diversification can reduce fragility, but duplicate suppliers, smaller runs, and backup capacity may cost more. The owner is balancing efficiency against resilience. The cheapest supply chain is not always the safest, and the safest is rarely the cheapest. Contingency planning is a cost of ownership even when the contingency never occurs. So, what does a durable clothing brand actually own? Inventory is necessary, but it can lose value. A logo is useful, but it does not create loyalty by itself. The stronger assets are accurate customer data, permission-based communication, trusted product quality, supplier knowledge, creative systems, operational records, and a community that pays attention without being purchased again for every launch. Those assets can lower acquisition dependence, improve forecasting, and support new products. They are also built slowly through repeated delivery, not purchased instantly with one advertising campaign. The owner's job is therefore broader than fashion taste. It includes financial planning, inventory control, merchandising, marketing, data analysis, supplier management, compliance, customer service, and cash preservation. Design talent can create the reason a product deserves attention. Operational discipline determines whether the company survives long enough to earn that attention repeatedly. Passion matters, but passion cannot reconcile a cash flow statement or identify a return problem by size. A realistic ownership assessment begins with a few disciplined questions. What is the fully landed cost byproduct? How much contribution remains after fulfillment, shipping, processing, discounts, and expected returns? What is the blended acquisition cost for a genuinely new customer? How many customers purchase again? How soon? And at what contribution? How many months of fixed expenses and inventory commitments can the cash reserve support? What happens if a shipment is late, a platform account is restricted, or a best-selling item needs to be remade? The answers will not guarantee success, but they reveal whether the brand is being managed as a business rather than a collection of attractive products. Owning a clothing brand can produce a valuable company, but the value is not created by multiplying a factory invoice by a retail markup. It is created when the brand repeatedly converts attention into profitable orders, turns inventory back into cash before it becomes obsolete, keeps its promises, and retains enough contribution to fund the next cycle. The hoodie is the visible product. The real business is the coordinated system behind it: supply, story, customer trust, and cash flow. When that system works, revenue can become profit. When it does not, an impressive sales number is only money passing through an expensive machine.